know that feeling. The one that investing is probably about picking the next hot stock, perfectly timing the market, or maybe finding that one genius broker or fund manager with the secret sauce.
Yeah, it feels like there's some hidden knowledge out there, right?
Exactly. And that perception is incredibly common.
Mm-hmm. The financial world often kind of markets itself as this place of, complex secrets and expert gurus.
Well, today we're cutting through all that noise. We're taking a deep dive into some really powerful excerpts from William J. Bernstein's The Four Pillars of Investing.
Right, and it's a book grounded in what the science of investing actually tells us, not just, gut feelings.
And our mission here is pretty simple, really, to help you understand those fundamental truths from the source material.
Think of this as your shortcut, maybe, to being genuinely well-informed, so you can spot those common pitfalls and hopefully avoid costly mistakes.
And right away, there's a surprising insight that kind of sets the stage. Unlike physics or engineering, where you build a bridge and expect predictable outcomes based on these unchanging laws.
Finance isn't like that. It's a social science.
And that distinction is huge, isn't it?
Oh, it's absolutely critical. It means financial systems aren't static. They involve, human behavior, psychology, evolving institutions.
So you can't just plug numbers into a formula and expect the same result every single time.
Exactly. What worked yesterday might not work tomorrow. It's dynamic.
So for your money, this means things don't behave like clockwork. And maybe most importantly, history isn't just a bunch of dusty facts.
Oh, it's essential. Bernstein puts it pretty starkly, actually. He says an investor unaware of financial history is irretrievably handicapped.
Wow. Handicapped.
Yeah. History provides that crucial context. It shows us how market patterns, especially the behavioral ones, tend to repeat over centuries even.
Okay, let's unpack this then. Let's jump into the first pillar, investment theory.
Right. So at its core, investment theory gives us this unshakable link between risk and return.
They go hand in hand.
Fundamentally inseparable.
Okay.
If you want higher returns, you have to accept higher risk.
Yeah.
There's no way around that.
And we see this play out all the time, don't we? A market shoots up like crazy.
And it can crash just as fast. That stock that was a 900% winner,
Yeah.
it can just as easily turn into a 90% loser.
Yeah.
That's the risk part.
Okay. So this simple truth should make you instantly skeptical of, say, your broker calling with a hot stock tip.
Oh, the classic call. Yeah, you should be very skeptical.
Why specifically?
Well, as the source points out, think about it. If they really knew a stock was guaranteed to rocket,
They wouldn't be telling me.
no, they'd be borrowing every dime they could, buying it themselves, and, planning their retirement on a beach somewhere.
Yeah.
The fact they're calling you tells you everything.
So predicting those short-term market moves, basically impossible.
Not reliably, no.
Yeah.
Not for anyone, not pundits, not strategists, not brokers. It's just not something humans are good at.
But it's fascinating. The source mentions that measuring probable returns over the long haul, like from dividends and earnings growth, isn't actually that hard.
That part is more predictable, yes. The fundamental return.
Yet experts still get overall returns wrong so often. Why?
Because the speculative component.
Yeah.
The short-term price swings driven by emotion, by liquidity, by news, that completely overwhelms the predictable part in the short and medium term. That's the noise. That's the unpredictable bit.
Okay. And this leads to something that is maybe one of the most counterintuitive truths in the book, and maybe a little deflating for people trying hard to pick winners.
You mean the idea that most differences in money manager performance come down to luck?
Yeah, exactly. Not skill.
It's a tough pill to swallow, but the data Bernstein presents is pretty compelling. You aren't consistently rewarded for trying to pick star stocks or star mutual funds or brokers or hedge funds.
So all that effort might be wasted.
Well, the studies show their results are often indistinguishable from, or sometimes even worse than, just random chance, especially after you account for their fees.
Worse than flipping a coin. How can that be?
It sounds incredible, I know. But think about the fees and expenses these active managers charge. They start at a disadvantage compared to just owning the whole market through a cheap index fund. Over time, that fee drag, plus the sheer difficulty of being right more often than wrong consistently, it makes outperformance really, really rare.
And even harder to predict who will outperform beforehand.
Exactly. Almost impossible.
So picking individual winners or star managers isn't the answer. Where does the real risk lie for an investor? The source says it's not just the volatility of one stock.
Right. The biggest risk you face, according to Bernstein, is actually failing to diversify properly.
Putting all your eggs in one basket, basically.
Or even just a few baskets. Concentrating your investments, even in things that seem safe, leaves you exposed to risks you could otherwise smooth out.
And what truly matters isn't how any single stock does.
No, it's the behavior of your entire portfolio, how all the pieces work together.
And this is portfolio theory.
That's the essence of it, yeah. It's the science, if you will, of how different asset classes like stocks, bonds, maybe real estate, international investments interact when you combine them.
And the mix can behave differently than the parts.
Oh, absolutely. A well-diversified mix can often give you lower risk for the same potential return compared to just holding those assets individually. It's about the blend, the synergy.
Okay, that framework makes sense. So if finance isn't a hard science, and theory gives us risk return and diversification, where do we find the real-world lessons? How markets actually behave?
That's pillar 2, history. As we touched on earlier, ignoring history. You're flying blind.
Right, the irretrievably handicapped investor. So what kind of insights does history give us?
Centuries of it tell us about short-term swings, which can be wild, versus long-term behavior, which tends to be a bit more predictable in terms of risky return patterns.
And it highlights the psychology part, too.
Definitely. The cyclical nature of public psychology, how crowds can become, as Bernstein puts it, psychotically euphoric at tops or toxically depressed at bottoms.
And this isn't just about, like, the last 50 years.
Not at all. The source traces credit markets back to the Fertile Crescent. Governments issued bonds centuries ago, and their prices went up and down based on conditions, just like today. The fundamentals haven't really changed.
Let's dig into some specific examples from the book. European interest rates from 1200 to 1800.
Yeah, that long view shows that high returns on lending happened during times of really high risk, like anarchy, destruction, like around the French Revolution.
Okay.
And low returns. They coincided with periods of stability, like late Victorian England. The risk-return link holds up across centuries.
The book also uses annuities or perpetuities to show how interest rates affect value.
Right. A perpetuity is just a loan paying interest forever. Yeah. Its value is simple math. The annual payment divided by the current interest rate.
So if rates go up,
the value goes down. If you get $100 a year and rates are 5%, it's worth $2,000. If rates double to 10%, that same $100 a year stream is only worth $1,000. Value gets cut in half. This inverse relationship is constant for fixed income.
And that even applied way back with those forced loans in Florence.
Exactly. If your loan paid 5%, but the market demanded 6.7% for similar risk, nobody would pay face value for your loan. Its price would fall until its yield matched the market. Risk the chance of not getting paid back fully meant the price fluctuated. History just keeps confirming it.
History also shows these massive shifts, right? Like the U.S. going off the gold standard.
Huge change. Around 1913, it completely flipped the script. Bondholders, holding assets with fixed dollar payments, got hammered by inflation over time under the new paper currency system.
The stockholders,
whose companies could raise prices and potentially grow earnings and dividends along with inflation, actually saw their real value protected or even enhanced over the long run.
And the source says it took investors more than a generation to figure this out.
Yeah, incredible, isn't it? Shows how slow we can be to adapt, even to fundamental economic shifts.
Okay, so looking at long-term stock returns, the really good data is mostly the last 200 years in the U.S., maybe less globally.
That's generally right, yeah. Robust data gets scarcer the further back you go.
And the source stresses the difference. Bonds are loans, limited upside. Stocks are ownership, a claim on future earnings, potentially unlimited upside.
Right, and you see those charts showing $1 invested in stocks growing massively over 100 years.
Yeah, those are impressive.
They are, but log-scale charts especially can kind of smooth over the terrifying volatility along the way. History reminds us it's not a smooth ride-up.
Which brings us to those times when markets go, what does the source call it, barking mad?
Yeah, barking mad. About once a generation, he argues, markets detach from reality. They enter these states of extreme mania or depression. Bubbles and busts. It's different from just a normal downturn.
What are the conditions for a mania? The ingredients?
Bernstein lays out a few key ones. Usually, you need some major technological or financial change, something new and exciting.
Okay.
You need easy credit, lots of liquidity sloshing around. You need a kind of collective amnesia about the last bubble, which often takes, about a generation to forget the pain.
Makes sense.
And crucially, you need people to abandon traditional ways of valuing assets. They start saying, this time it's different.
And history's littered with these. The diving company bubble, 1680.
Yeah, maybe the first tech bubble. Patents for dodgy diving engines, seemingly just to create stock to sell. Daniel Defoe, the writer, apparently went bankrupt around then. It shows markets can raise capital, even for silly ideas, but the mania part is when the price goes nuts.
Then the big one, the South Sea Bubble, 1720.
Right. The displacement there was swapping government debt for shares in the South Sea Company. The company itself had an incentive to pump its stock price higher to make the swap look good.
So investors traded their safer government bonds for these rising shares.
Often on margin, borrowing money to buy more. And there was outright skullduggery, too. Counterfeit shares given to influential people.
And then the government tried to step in with the Bubble Act,
Which ironically popped the bubble. It forced some key lenders to stop operating, liquidity dried up, and boom, crash. The price fell back towards something resembling fair value.
What other bubbles does he mention?
Railway mania, 1840s, the steam engine was revolutionary, visible, everyone wanted in.
Okay.
Investment trusts in the 1920s started okay, then got crazy leveraged, pyramiding structures.
Sure.
Goldman Sachs Trading Corp selling for twice its asset value right before the '29 crash.
Wow.
The Tronics bubble, late 50s, space race excitement, companies just adding Sonics or Tronics to their names, IPOs doubling on day one, then collapsing later.
Familiar story.
The conglomerate bubble, late 60s, boring old smokestack companies bundled together, trading at insane multiples based on accounting tricks until earnings disappointed.
And the one many of us lived through, the internet bubble, late 90s, early 2000s.
Oh yeah, just unthinkable valuations. Companies with zero earnings trading at thousands of times sales. Telocity at 5,200 times sales. Internet Capital Group worth 10 times the tiny companies it actually owned. It was pure narrative, zero fundamentals.
So the core lesson from all these crazy manias throughout history.
When things feel completely off the rails, when everyone's saying it's a new era, remember John Templeton's warning? The four most expensive words in the English language are, this time it's different.
Because history screams, it rarely is.
Exactly.
Now, just as extreme as the tops are the market bottoms.
Right. And importantly, you can only really know it was a bubble after it bursts.
But those periods of extreme pessimism, wow. The source talks about that 1979 Businessweek article, The Death of Equities.
Can you imagine the cover of a major business magazine declaring stocks dead? The consensus was, dump stocks and bonds, buy gold, buy real estate. Those paper assets were finished.
And it said only old fogies own stocks.
Yeah. It's just incredible how much sentiment can swing. It shows how powerfully we're influenced by whatever's happened recently. Just like it was hard then to imagine stocks recovering, it can be hard now to imagine, say, tech stocks performing poorly for a decade.
The source also paints a picture of 1932, the Great Depression bottom.
Just brutal. Prices were so low, the dividend yields were near 10% for years. Stocks trading way below book value. Compare that to today, where the average S&P 500 stock might be 6 times book value.
And anyone buying stocks then?
Was considered certifiable, according to the source. Completely nuts, because things look so bleak.
So history just hammers home this cycle. Irrational highs, crushing lows.
Absolutely. And it's driven by behavior. Richard Thaler, the behavioral finance Nobel laureate, says all finance is behavioral. These boom-bust cycles haven't been abolished because human nature hasn't been abolished.
So while we might see exuberance now, we should fully expect extreme pessimism again at some point.
It's a near certainty, based on history, which leads us perfectly into Pillar 3, psychology.
Right, because if history shows markets are behavioral, this pillar digs into why. Why our own brains trip us up.
This is what Bernstein calls the deadly quicksand of maladaptive behavior. Our own human nature is often our worst enemy in investing.
What are the main traps highlighted in the source?
Things like gross overconfidence, paying too much for glamorous assets, trading way too often, making emotional decisions instead of rational ones.
And herd behavior seems like a huge one.
Oh, fundamental. We're social animals. We follow the crowd in fashion, in politics, and definitely in investing.
Which means?
It means we tend to buy when everyone else is excited and prices are high, and panic sell when everyone else is terrified and prices are low, the exact opposite of what you should do.
And overconfidence. The source says that might be the most important error.
It's huge. And it's tricky because the feedback loop in investing is so long and noisy. Make a bad trade. Might take years to see the damage, unlike, say, a surgeon making a mistake.
Right. The consequences aren't immediate.
So we don't learn easily. We think we're better than we are. This leads to these illusions of skill.
Like thinking you can consistently pick winning stocks.
Yeah, believing you've got the magic formula or can rely on some newsletter. The source asks a tough question. Are you really smarter or better informed than the pros on the other side of your trade? They have way more resources and motivation. The evidence says very, very few people, even pros, have durable stock-picking skill.
Or the illusion of picking winning managers.
Same idea. If the biggest pension funds, with billions to invest and teams of analysts, find that over 90% of active managers failed to beat their benchmark index over time.
What chance do I have of picking one of the few winners in advance?
Exactly. It's why those big funds are increasingly just using index funds. They've learned it's a losing game.
And trying to time the market. Illusion number 3.
The data here is just brutal. Studies show market timers, on average, do worse than random chance. Like, less than a quarter of their calls are right. There's no consistency among the rare winners, but plenty of consistent losers.
Ouch. Okay, what about recency bias?
Oh, this one gets everyone. We let whatever just happened in the market totally dominate our expectations for the future.
So after a big boom, everyone expects 20% returns forever.
Pretty much. It's incredibly hard to convince people otherwise. We overweight recent experience and forget the long-term averages.
Which ties into mean reversion.
Right. Assets tend to revert towards their long-term average performance over periods longer than, say, 3 years. Good periods tend to follow bad, and vice versa.
So the hot asset class of the last few years is probably
statistically a bad bet going forward, but recency bias makes us want to buy it. We chase past performance.
There's also the need for excitement, like gambling.
Yeah, humans are drawn to that low probability, high payoff thrill. The lottery ticket, the long shot at the races.
How does that play out in investing?
We gravitate towards speculative stocks, the story stocks, the ones with a tiny chance of a massive payoff, instead of focusing on boring, reliable fundamentals.
And this helps explain why growth stocks often underperform value stocks long term.
Exactly. People overpay for the excitement and the prospect of rapid growth. Bernstein gives that great example. Smokestack Inc. at 20 times earnings versus Glamour Concepts Inc. at 80 times earnings.
Okay.
Even if Glamour grows way faster, its starting price is so high that its earnings per share down the road might still be lower than boring old smokestacks. And when Glamour's growth inevitably slows...
the market hammers it.
Exactly. Because the price was built on unsustainable hype, not reality.
And the last psychological trap mentioned, seeing patterns where there aren't any.
Yeah, our brains are pattern recognition machines, but the market, especially short-term, is mostly random noise. Trying to find predictive patterns is usually futile and leads to bad trades.
Like those spurious correlations journalists find?
Right. Like Bangladesh butter production predicting the S&P 500. It's nonsense, but we desperately want to find order in the chaos.
So how do we fight all this? Our own nature.
The source suggests a few things. 1, identify whatever the current conventional wisdom is and assume it's probably wrong.
Counterintuitive.
Definitely. 2, keep your investments private. Talking about them invites comparison, herd behavior, bad decisions. 3, honestly confront your own overconfidence. Be humble about your ability to predict the future.
And there's that really striking point the source makes. There are no great companies from an investment standpoint.
Yeah, it sounds weird, right? Obviously, they're great businesses, but the market usually knows they're great and prices them accordingly.
So buying a great company doesn't mean you'll get great returns.
Often, no. It's usually counterproductive because you're paying a premium for quality that's already well known. History actually shows the dullest, most boring companies often have higher stock returns.
Because expectations are lower and the price is more reasonable.
Exactly. Walmart and Microsoft were rare exceptions where massive growth wasn't fully priced in early on, but building a strategy on finding the next Microsoft is like buying lottery tickets.
Okay. Theory, history, psychology. Pillar 4 is understanding the investment business itself.
And this one's critical because, as Bernstein puts it bluntly, you're kind of locked in a financial life and death struggle with the industry.
That sounds intense.
It is, but he argues their basic goal is often to transfer as much of your wealth to their ledger books as they can. We need to understand their incentives.
The key players being brokers, mutual funds, and the financial media.
Right. Let's start with brokers. That chapter title says it all. Your broker is not your buddy.
Why not?
Their income often relies on generating trades commissions, fees. A broker whose clients just buy and hold isn't making much money.
So their incentive is turnover.
Exactly. Maximize turnover. Your incentive is to minimize turnover and costs. Your interests are fundamentally opposed.
And that crucial point about fiduciary duty.
Right. Brokers typically don't have a legal obligation to put your interests first. They just need to recommend something suitable.
Which could be almost anything that pays them a commission.
Pretty much.
Yeah.
A fee-only investment advisor, on the other hand, usually does have that fiduciary duty. Their income is tied to your assets growing, not how often you trade.
Yeah.
That aligns incentives much better.
The source also suggests many brokers, while good at selling, don't have deep finance knowledge.
Yeah, the evidence suggests they're trained primarily to sell products, not necessarily to be sophisticated investors understanding things like the long-term drag of fees or efficient diversification. It's telling that many insiders reportedly use index funds themselves.
Okay, what about mutual funds? The source says they exist mainly to gather assets.
Yes, their business model is based on assets under management, which generates fees, regardless of whether they actually deliver good performance for investors.
And the average investor in these funds doesn't do well.
Sadly, no. They tend to chase performance buying high after a fund has had a good run and selling low when it inevitably cools off or the market drops.
So the fund's reported return might look good, but the actual return the average person got is much lower.
Exactly. The source calls this the difference between time-weighted return, what the fund reports, and dollar-weighted return, what investors actually experienced. Dollar-weighted returns are often dramatically worse, sometimes lagging symbol index funds by huge margins.
So most people miss the good early returns and hop on the bandwagon just before it crashes.
That's the pattern the data shows. And again, look at the big institutions, the pension funds. They've tried active management for decades with the best resources.
And failed, mostly. Over 90% underperform.
Right, which is why they're moving billions into low-cost index funds. They've learned the lesson. Small investors, largely, haven't gotten the memo yet.
And the source strongly advises avoiding certain products.
Definitely. Load funds, funds with upfront sales charges, often around 4.75%, you start in a hole you might never dig out of.
Just throwing money away.
Pretty much. And variable annuities. They're often sold aggressively, pitched for tax benefits, but they have incredibly high fees that usually wipe out any advantage, especially if held inside an already tax-advantaged account like an IRA. Bernstein says you get less than nothing for the fees.
But there was a positive force, right? The Vanguard Revolution.
Absolutely. Jack Bogle was a game changer. He saw the data on active management failure and built a totally different model.
How so?
He set up Vanguard as mutually owned. The fund shareholders own the company itself. No outside profit motive. Then he launched the first retail index fund in 1976 based on the academic evidence. And crucially, he sold it directly with no sales loads.
Low costs were key.
Totally. It started slow, but then a virtuous cycle kicked in. More assets meant economies of scale, which let Vanguard lower expense ratios further and further way below competitors. Lower costs meant better relative performance, which attracted more assets. It fundamentally changed the industry and forced costs down everywhere.
Okay, the last piece of the business puzzle, the financial media.
Which Bernstein calls, pretty bluntly, advertising cloaked as journalism.
Wow. So consume with extreme caution.
Yeah. You can't avoid it entirely, but understand how it works. Part of the issue is that many journalists aren't necessarily experts in the deep academic finance literature. They're reporting on market chatter, analyst opinions, people with skin in the game.
Like getting medical advice from USA Today instead of a peer-reviewed journal?
Kind of, yeah.
Yeah.
And the source includes that anonymous quote from a former mutual funds reporter. Pretty damning.
What did they say?
Basically that they knew they weren't really helping readers make good long-term decisions. They were preaching buy-and-hold marriage while implicitly endorsing hot fund promiscuity.
Because chasing hot funds sells magazines.
Exactly. Rational, boring stories about indexing don't get clicks or sell ads. The business model encourages hype. It's revealing that many financial columnists themselves apparently invest in index funds.
Okay, so they got the 4 pillars. Theory, history, psychology, and the business. How do we pull this all together and actually build a winning portfolio?
Right. The key takeaway from the source is it's about executing a strategy based on this evidence. It's not about predicting the future.
So step 1 isn't guessing which stock or sector will be hot next year.
Definitely not. That's a losing game, as history and psychology show us. Step 1 is defining your long-term asset allocation.
A mix.
Yeah, your mix of stocks to bonds, U.S. to international, large cap to small cap, value versus growth. This decision, based on your personal risk tolerance and financial goals, not market forecast, is like 80% of the work, according to Bernstein.
And the tools to implement this allocation.
Primarily low-cost, broadly diversified index funds, especially for your core holdings, like U.S. stocks. The source suggests using total market indexes if possible, like the Wilshire 5000 or Russell 3000, which capture more than just the S&P 500.
Get the whole market cheaply.
That's the idea. Broad diversification in one go.
And taxes matter in choosing which funds go where?
Oh, definitely. Some asset classes, like REITs or maybe small cap value funds, tend to generate more taxable income or capital gains distributions. So they might be better suited for tax-advantaged accounts like an IRA or 401k, if you have them.
Keep the tax-inefficient stuff sheltered. Makes sense. And diversification. The only free lunch.
Still holds true. It's the best way to reduce risk without automatically slashing your expected return. It means owning bits of everything. U.S. stocks, international stocks, emerging markets, real estate via REITs, different kinds of bonds. Don't just stick to one corner of the global market.
The source gives a practical way to build this diversification over time, right? As your savings grow.
Yeah, it suggests starting simple, maybe just a U.S. total stock market index fund initially. Then, as your portfolio hits certain milestones, say every $5,000 or $10,000 saved, you add another slice. An international fund, then maybe a REIT fund, the small cap value, and so on.
And use a money market fund as your initial bond holding.
Right, for stability and liquidity early on. You build complexity gradually.
When you're adding money regularly, the source mentions something called value averaging.
Yeah, it's a disciplined way to invest. In simple terms, you set a target for how much your portfolio should increase each period. If the market drops and you're below target, you have to invest more money that period to catch up.
And if the market booms and you're above target,
You invest less, or maybe even nothing. It forces you to invest more when prices are low and less when prices are high.
which feels totally backwards. Buying more when things are falling feels awful.
It feels terrible.
Yeah.
And that's exactly why it works and why psychology is the main obstacle. It automates the buy low, sell high discipline that our emotions fight against.
Then small investors actually have an advantage here.
In a way, yes. You only have to manage your own emotions. Big institutions have committees, clients breathing down their necks, questioning why they're buying stuff that just went down. It's much harder for them to go against the herd or drive the wrong way up a one-way street, as the book says.
Which leads to rebalancing, another key discipline.
Absolutely essential. Regularly bringing your portfolio back to your original target percentages.
How does that work in practice?
It means you sell some of the assets that have performed best because they've grown to be too large a percentage, and use the money to buy more of the assets that have performed worst because they've shrunk.
Selling winners to buy losers, that sounds painful too.
It always feels wrong in the moment. But the source shows an example from 1998-2000 where a rebalanced portfolio significantly outperformed one left alone. It doesn't guarantee better returns every single year, but it systematically controls risk and keeps you aligned with your long-term plan.
What about for people living off their portfolio, say, in retirement? The source talks about sequence of returns risk.
Yeah, this is a big one. It's the danger that if you get a string of bad market returns right after you retire, drawing down your money can deplete your savings much faster than expected, even if long-term average returns are okay.
So the order of returns matters hugely when you're withdrawing.
Critically, the source discusses withdrawal strategies. Taking out a constant real amount, adjusted for inflation, each year is risky. Historical simulations suggest a safe withdrawal rate might only be 2–5% of your initial nest egg, maybe even lower if future returns are weak.
What's the alternative?
Taking out a constant percentage of the remaining portfolio each year, your income will fluctuate with the market, which isn't always comfortable, but you're much less likely to run out of money.
And dealing with taxes in taxable accounts adds another layer of complexity.
Right. Selling appreciated stocks means capital gains tax, so there's a temptation to just spend bond income first. But that makes your remaining portfolio riskier over time. Tax-advantaged accounts like IRAs offer a huge advantage here for managing withdrawals and rebalancing without immediate tax hits.
It really keeps coming back to discipline, doesn't it? The strategy seems clear, but doing it is hard.
That's the crux of it. Watching your hard-earned money seem to evaporate in a market crash is emotionally brutal. An advisor can potentially help with discipline, acting as behavioral coach.
But you have to watch their fees and make sure they're a fiduciary.
Absolutely critical. Otherwise, their advice might be tainted by their own incentives.
Okay, now the source includes a really interesting look back at a specific recent decade, 2000 to 2009.
Yeah, that section is fascinating. It was a terrible decade for the main U.S. stock market index, the S&P 500. It actually lost money over those 10 years, down over 9% total.
A lost decade for U.S. large-cap stocks. But what about other assets?
That's the kicker. The source shows a table. U.S. large value, U.S. small cap, U.S. small value, REITs, real estate. International stocks, especially value and small cap, and emerging markets.
Yeah.
They all had positive returns.
Some significantly positive.
Oh, yeah. REITs were up over 170% in that decade. Emerging markets over 160%. U.S. small value over 120%.
Wow. So the lesson from that specific period.
Diversification wasn't just some abstract theory. It was absolutely crucial. The further you diversified away from standard U.S. large-cap stocks during that specific decade, the better off you were. It powerfully reinforces that you just can't predict which asset class will be the winner.
And if we connect that decade to the bigger picture, especially the 2007-2009 crash within it,
it hammered home the ferocious risk attached to high returns. Bernstein notes that experiencing that kind of wealth destruction live is fundamentally different from seeing it on a chart.
it teaches you about risk in a way a book can't.
Exactly. It sears the reality of risk into your brain.
So given that risk, and given that things like safe government bonds or money markets have lower expected returns, why hold them at all? Why not just go all in on the higher returning stuff?
Because you need those stable, liquid assets for several reasons. One, life happens. You might lose your job, face unexpected expenses, especially during a downturn when markets are low. You need cash you can access without selling stocks at the worst possible time.
The emergency fund aspect.
Right. And two, crucially, you need that dry powder to execute your rebalancing strategy. When stocks crash and everyone else is panicking, that's when your plan says to buy more. You need cash or bonds available to sell to make those purchases.
So they're not just ballast, they're ammunition.
Perfectly put. They allow you to stick to your plan and potentially take advantage of downturns, buying when assets are cheap. The source advises holding enough liquid assets to survive a bad patch and execute your strategy.
And having lived through periods like 2000, 2009, or the '08 crash,
Bernstein says you should consider yourself privileged, in a way. You got a painful but invaluable real-time lesson in risk and return. Don't forget it. Carry that brutal lesson with you.
Okay. So, wrapping this all up, what does this mean for you, the listener tuning in today? We've gone through Bernstein's 4 pillars. Theory.
Risk and return are linked. Diversification is key.
History.
Markets are cyclical, driven by emotion. Bubbles and busts happen.
Psychology.
Your own brain is wired to make mistakes, overconfidence, herd behavior, recency bias.
And business.
The industry often has conflicting incentives. High fees erode returns. And the sources make a really powerful case, based on decades of evidence. You probably can't consistently pick winning stocks or managers. You definitely can't time the market reliably. And a lot of the financial industry isn't really set up to help you, but rather to profit from you.
So the power isn't in trying to outsmart everyone or find some secret guru.
No. The power lies entirely in adopting, and more importantly, sticking to a sound strategy based on these pillars.
Which means?
Diversify broadly across asset classes using low-cost index funds. Define your stock bond, etc. Allocation based on your long-term needs and risk tolerance, not forecasts. Build your portfolio methodically over time. And rebalance regularly, no matter how uncomfortable it feels.
And it will feel uncomfortable. That psychology pillar is maybe the hardest part.
Absolutely. You'll feel the pull of the crowd when things are euphoric. You'll feel that gut punch fear wanting you to sell everything in a crash. Rebalancing literally forces you to sell what's working and buy what's not. It feels like you're doing everything wrong.
But remember that core insight from the source. The capital markets act as this giant mechanism.
Transferring wealth. From those who don't have a coherent evidence-based strategy, or who can't stick to it when things get tough.
To those who do have a strategy and who can maintain the discipline to follow it through thick and thin.
Building the strategy itself, after understanding these pillars, isn't actually that complicated. The real challenge, the one no book can fully prepare you for, is having the emotional fortitude, the discipline, to just execute that plan consistently year after year, decade after decade, through whatever madness the market throws at you.
So here's a final provocative thought for you to take away from our deep dive today. If the evidence, the science of investing, points so clearly away from chasing hot tips, picking star managers, and trying to time the market, what is the single biggest obstacle remaining between you and achieving your long-term financial goals? And maybe more importantly, now that you likely know what that obstacle is, your own ingrained behavior, how will you build the discipline, the systems, the mindset needed to overcome it?